there's a whole other section of your career here as an investor. And so you went from equity research next to the PM role. That's fascinating. Such a big shift. So when you went to Eastmore as a PM, what changed? Like, what was fundamentally the mindset shift between going from making a recommendation to actually owning the risk?
It felt very natural, to be honest. It really did. Like, the only difference is like, because you're still sticking your neck out, the only difference is you're putting money on, right? So it felt very natural to me. And in some ways it felt easier, because there wasn't there's accountability, but like, there's no accountability for changing your mind. Like, you can just be like, you know what, this isn't working, I'm out, like, whereas when you're in equity research, it doesn't matter. Like, ultimately, even if you change your mind 3 months later, like, somebody's going to give you a hard time for that. Like, it's just the way it is, like somebody owns a stock. They're like, why are you downgrading this? I'm like, well, I don't like it anymore. It's so it felt like a very natural transition, because ultimately, and it all felt very natural. Like, whether you're like whether I was a specialist institutional sales guy, because you're ultimately advising and you're picking stocks for people, you're helping them make money, and like you're doing the same thing in equity research, and so like going to the buy side it was a very natural transition from those roles. So it felt like I felt like a fish in water, when I started. So.
Nice. Well, I'm glad to hear that it wasn't too crazy.
It felt right.
Yeah, and I guess the intellectual process in some ways is the same, where you're basically looking at an asset and deciding, like, do I think it's a good asset or not? Like, fundamentally, the question's the same. The way that you monetize that thinking, though, is different. And so let's go back to that process, though. The process of idea generation to diligence to sizing to exit. Like, what does that look like from start to finish in the PM role?
It's it varies, but generally speaking, it's and this is the way I do it, right? Some people do things differently. This is just how I do it, and it's how some people do it. I look at my world, and I know it. I know how these stocks trade. I know who's in and out of them. I understand the mosaic of where the pieces go, how the supply chain works. And ultimately, I kind of approach things from a sort of sector perspective, but almost more from a top-down perspective, like, meaning I'll identify like a theme I like, within that top-down theme, what are the best stocks to own in that context, right? So I'll give you an example. Like, for like right now, I think one of the areas in semis that's is very hot right now is sort of the commodity area of semis, which is like memory, right? And it's very hot right now because a lot of the AI build out is sucking up a lot of high end memory capacity from the likes of Micron and SanDisk and companies like that. So like storage and memory, these are commodity areas. When they get tight, they get really tight, right? And so ultimately, that's great for them. And we're at a time now where you're probably seeing, it's almost a super cycle. And what is a super cycle? Super cycle is when you have like the highest peak margins you've ever seen, right? And that's what's happening now. So, I like that side of the equation. And on the flip side of that, what gets hurt by that? Well, people who buy that stuff, right? If you're buying memory and storage, if you're a hardware company like Dell, that's a problem, right? So anyway, I develop a theme like that, and then I try to find the best stocks to go long or short within that theme. And if you can find something that's got duration, you can trade around it. But like, that's a great way to make money, because like you're in a long short context and you love both sides of the trade, right? But that's how I do it. For me, it's more top down, right? And within a sector framework, right? There's the occasional, sort of bottoms up idea I will recognize and like. But the process goes, develop a theme, then I'll go, I'll talk to managements. You get on the phone with them, or you visit the company. You talk to the sell side. You talk to research analysts, you talk to industry people, you sort of develop your mosaic to either validate or disprove what you think. And then you kind of run the numbers on things. Basically, you can do that in two ways. You run your own models. You have somebody doing it for you. In this case, I have people doing it for me now. Yeah. And then you make a call. And then the one thing that changes, I would say, on the buy side in terms of the process relative to the sell side or equity research is really kind of like you really want to gauge when you're getting into an idea. It's gauging the risk reward, right? How much money can I lose on this, and how much money can I make on this? Mm-hmm. What's the upside downside case? And you do that on a sort of like a stock by stock basis, right? Mm-hmm. That's kind of how the process works for me. It's different. Gotcha. It's different for some people, but it's kind of relatively the same in terms of
it has to have the same pieces in terms of like looking at industries, looking at assets, deciding them. And I think that applies with private markets too. Like as a private equity investor, is the same thing. Like we build an industry thesis, you find the asset in there that like is the best mix of price and like quality. And then you have to figure out like the price that you can pay, and you have to figure out how long you can hold it and when to sell. And so the only difference I would say with PE versus this sort of PM role is that there's an operational component too, where you're saying like, hey, change this. And so unless you're like in an activist PM role, then like probably that's not quite as relevant. Is that fair comparison?
Yeah. Okay. I think that's a very fair comparison. Yeah. I think the one thing, I mean, I'm biased, and because I work in public markets, and I'm envious of private investors. Like I wish I had that kind of comfort to, so I make fun of it sometimes. Like, it's a cushy job, like it's just a hard job to get, but once you get it, it's easy. Because I have a mark every day, right? Whereas like, we buy this thing, I could kick back 5 years, watch it grow, and see whatever, That's not really how it works, but from my perspective, sometimes it feels that way, So generally, that I would agree that's the difference.
Doesn't feel quite like that on the inside, but I hear your point. It's nice to have like a little bit of breathing room where you don't have to think about the day-to-day performance. In fact, we would sell our CEOs on that sometimes, where we'd be talking with a public company. We'd say like, hey, you're spending a lot of time on earnings calls, talking with analysts, talking with investors. Everyone's breathing down your neck. Your employees are begging you for like the stock to go up so that their options are worth something. Like, let's take you private. Just focus on the business. Like, don't worry about any of that sort of capital market stuff. Just like focus on the business, because it could be distracting. Like there's a lot of stuff going on. It's so intense, so always on, like we were talking about earlier. So I get it.
Yeah.
But going back to the process a little bit more, something that I have had problems with when I'm building a thesis in an industry is sometimes I fall so in love with my thesis that I'm willing to buy any company, anything that breathes in that arena. And so how do you build conviction without falling in love with your theses?
That's not an issue I have generally. I would say that's the one thing that's probably made me pretty good at this. I can take in like, I generally think that's like a personal strength of mine. Like I can be objective and take in information and change my mind. Like even if I'm really, if I'm really convicted on something, I can be. But situations change. I don't have any issue doing it. I think, frankly speaking, that's a very, very important thing when you're an investor. It's understanding the difference between having conviction and not having courage. Because like sometimes like things are go against you, and like you got to have the courage to not change your mind sometimes, right? I think that's as important too. So that's kind of like honestly, that's kind of it in a nutshell. Like what really makes an investor good. It's like that knowing when to kind of put the pedal to the metal and knowing when to change your mind. Like for me, the changing the mind thing is never the issue. Like because I can do that easily. It's when things are going against me, like riding it out, right? And sometimes you can't. Like sometimes it's just a risk management thing. If something's 20% against you, you're wrong. It doesn't matter whether you're going to be eventually right. You're wrong. Your timing's wrong. You're wrong. Right. That's the difference.
Yeah, exactly. As I think was it Buffett that said markets can stay irrational longer than you can stay solvent, or was that someone else?
Yes. I think that was him.
That's funny. Exactly. So your timing's wrong. You're wrong.
Yeah. I don't. Yeah. Yeah. No. That's the. Yeah. It's not. If you say well, I'm just early, then you're just wrong. You're not early. You're wrong. Anyway.
Yeah, that's funny. Yeah, I love that. And so another key element of a portfolio manager as opposed to like a private equity investor, and sorry to keep drawing this comparison, but I think it's fascinating, is you can take a portion of a company in a way that like PE is usually taking the majority, if not all, of the company. And so you can determine the size of the risk that you want to take. And so how do you think about the sizing when you like something, but uncertainty is still high?
Yeah, it's very that's a very strategy dependent. It depends on the type of fund you work for. It depends on the type of strategy you run. Like certain types of funds run very concentrated positions, right? And they're like, if I look at sort of the Tiger Cubs of the world, right? Like Viking and people like hedge funds like that who manage, $20 billion. And, they'll take more concentrated positions in things, and their way of the reason they believe they can do that, because, from their perspective, they think they're the smartest on that name at any given time. They know every piece of information that's going on about that company. They're totally in the weeds on what management is thinking, what's saying, so they think they can afford to do it. Now, from our perspective, I'm not gonna run money that way, because I'm not gonna be that person. There's just no way. I don't have access to those things. I don't have access to management in that way. I can get a management meeting, but it's just not going to be the same level of disclosure. So, for us, like a max sizing position high, we have all that stuff mapped out. So we know exactly what our max sizing is of something that's conviction. In our case, it's 7%. That's as big as we'll go in terms of the percentage of our total portfolio. And if once it starts getting bigger than that, we start to trim it. Because it's just a risk management thing. And obviously in a starter position could be anything. It could be 1% of our total portfolio, right? So, and also, sometimes you have to, like in our case, and this isn't the case of all funds, but in our case, we have to volatility adjust certain things. Like if there's a stock that has a market beta of 3, meaning the market goes up 1%, this can goes up 3%, meaning it's a highly volatile name. I can't, I can't afford to have that thing be 7% of my book. Like I can't have that day-to-day vol. I can't, because I'm managing money for I'm like, we have certain things called single managed accounts where you're managing money for like one fund of funds or one particular institutional client. And they don't want to see that day to day. They want to see kind of steady Eddie, right? So you have to manage it within the context of the volatility of that position and all that stuff. So this, what goes into sizing? A lot of different things, but also it's very strategy dependent.
Yeah, and probably client dependent, because like you're saying, some of your investors, like if you're managing money for the California pension retirement system or something like CalPERS, you probably can't have a 10x beta sort of like meme stock type thing relative to if you're working with like some very, very risk tolerant institutions or something like that.
Yeah, or you can. It can't be big, like we shorted a meme stock the other day. Right, because it's local, and it worked out. It worked out tremendously, to be honest with you. Because we shorted just because it was highly volatile. It had become a meme stock. We knew that it was like on the verge of declaring bankruptcy, and we had no intention of holding it for very, very, very long, like days, right? But we knew it was kind of like it had this ridiculous move, and so we shorted some, and they declared bankruptcy the next day. I mean, that was luck, but. But yeah, ultimately with those kinds of things, you have to. Yeah, that's a good day. You wake up, it's one of your shorts is down 70%. That's pretty good. But generally, you just have to volatility adjust the size, if you're going to buy stuff like that, because, ultimately what, as a long short hedge fund, most investors these days are looking for sort of, what's your risk adjusted return? Because like sure, you can make, a lot of guys can make 30%, but there can also be, those guys will be down 30%, and nobody wants that. Right. Mm-hmm. They'd rather have a fund that returns 10% every year than a fund that's up 50, down 20.
Yep. Yeah. That's fair. It's rational depending on your risk tolerance and what you're looking for in the stage of your investments, and it makes sense. Yeah. But congrats on the 70% down on your short position. That must have been pretty gratifying. Yeah. But when
it wasn't it was small though, because as I mentioned, we had to size, but nonetheless, still 70%, small position still makes a lot of money. So
still helps. Yeah, that's great. Well, good way to finish the year out here. And so telling me a little bit about like how the sizing evolves over time, like what triggers a trim versus a full exit for you? Is there some sort of threshold that you think about there?
Sometimes it's size, but very few people are going to sell a stock that's going up every day. Like, so even if it's getting pretty big and if it's really working, but ultimately you have to be a little bit of a valuation disciplinarian. Cause that's when you stop doing that for a minute, that's when you lose. You have to have your upside, downside case, kind of set in stone ahead of time, and you have to stick to it unless the circumstance, you really assess it and the circumstances have changed. Like, okay, well, the numbers are going higher than I thought. Okay, so it's worth more. But you never stay in something just because, well, the market's just going to continue buying it, and because ultimately that kind of crazy momentum sentiment, it reverses. It reverses, and when it does, it's painful, and you can get caught doing that. You never want to see yourself doing that, but you've done it. We've all done it. Like, okay, well, it's going to go up. It's going to continue to go up. And it doesn't make sense what people are paying for it, but I'm going to continue to own it anyway. And that's ultimately when, you get caught on the wrong side of something. So you have to have that upside downside scenario, set in stone, and you have to be disciplined in terms of sticking to it.
Yeah. Which is probably really hard to do, because to some extent, when markets get frothy, you still need to do your job. You still need to be doing things. And it's nothing feels good when that happens. And yet you still just have to keep going, right?
No, but it's funny, how often you realize, if I knew that was a ridiculous price for it. And ultimately the market comes around to it, and 3 months later it's down 50%, so you kind of have to have faith in that, and you have to have a faith in your understanding of historical valuation and being able to contextualize it, and and sometimes that's hard to do. It's not hard to do, particularly when things are really frothy and people are paying people are paying 40, 50 times earnings for, a hardware ODM, which is something typically people are paying 10 to 12 times. Well, they're building out all these AI, data centers. And so, now everybody wants a box, that's not a good business. It's a bad business, a low margin business. And ultimately, look at Dell's a good example, or Supermicro. These are good examples, right? These are companies, a year and a half ago, people were paying 25 times for. And ultimately what happened, they weren't really making as much money. They don't have any pricing power. And now what are those things worth? 10 times. A year and a half later. Okay. So
glad that it corrects, because I feel like one of the primary takeaways I had from my finance degree in undergraduate was that a lot of the movements are kind of random, and you shouldn't try and pick that, and unless you're a sophisticated institutional investor. And so it's fun and kind of interesting to hear a sophisticated institutional investor saying, no, in fact, there is some sort of justice to the markets, and in the end, it does sort of work out. So gratifying if that's true.
Yeah.